the 5 big downsides of investing in commercial property. Because let's face it, everyone talks about the upsides, the cash flows, and all about the growth and how much wealthy you can get in half the time. But the thing is, this 5 downsides is what most people miss. I'm going to tell you all of the downsides starting from number 5 to the worst downside. My name is Helen Tarrant. I help everyday Australians become wealthy through investing in commercial property. And I built the largest community in Australia of commercial property investors transitioning from residential. So if you're looking to start out, I am the place for you to follow, like, subscribe, everything. Find me on Insta, YouTube. Make sure you watch all my other videos. Now let's get started. Number 5, break lease clause. Break lease clause are the killers because your bank is going to say, oh, well, it's not really a 10-year lease, it's really a 3-year lease. Now, why is there a break lease clause? Well, the tenant might be a government tenant that doesn't get a government grant. The tenant might be a big project manager, or they might be in construction and they don't get a project, so they have to vacate. Or simply that they might be a laboratory, they might be medical, they're expanding and they outgrow their premises. Then they're looking at breaking that lease maybe in year 3 out of a 5 or 7 or 10-year lease. Now, that break lease clause is not going to be somewhere obvious. It's not going to be flashing lights. It's going to be very, very obscure. Now, if your buyer's agent can't read a lease in commercial property, you shouldn't be a commercial property buyer's agent. Every buyer's agent in commercial property need to be able to read a lease. This is a rookie mistake you'll likely make because before you make an offer, you have to know. And it just gets so expensive, you have to go and get solicitors to do that. Now, here at Unicorn, we have in-house legals to verify every single lease before we make an offer. Doesn't matter if you're buying a $500,000 property or $20 million property, you verify your leases, you verify your break lease clause, and who pays for what. One of the biggest downsides is you could get a lease that says buried that, oh yes, the tenant pays X, Y, Z, but they don't pay for land tax or they don't pay for the insurance, and all of a sudden you didn't realize that. After you settle, you go, oh, well, I end up with more payments, right? These are all part of the lease. This is one of the big downsides is that you have to know your break lease clauses. Number 2, compressing yields. Everyone talks about that. It is actually happening. Compressing yields means the returns are getting smaller. The price point of the property is getting larger. You have this in residential as you have in commercial. In residential, you call it capital growth, but in commercial, we call it compressing yields. Compressing yields happens all around Australia, but it doesn't happen in very regional areas or mining towns. You actually want to be in an area where there is compressing yields because that means you're getting capital growth and you're getting a lot more capital growth the faster the yields compress. However, you have to move very, very fast. If you want to buy in Metro right now before the market shifts, you've got to get in. You might not have got in at 6%. You might be able to get in at 5.8. Not much of a difference because in a blink of an eye, that yield is going to compress to 5.5 and you're going to get your growth. What yield compression means, yield is the cash flow return on the property. It's compressing, coming down, squishing it out because now the interest rate goes down and that means you have less cash flow. So the sooner you get into the market, the better. And that's really the only way. But make sure you execute with strategy. Without strategy, you're just buying blind and that could be the worst mistake you could make in commercial property. Now, number 3, CapEx. CapEx is what the commercial people call it capital works. A lot of people miss this. They go on and they look at a building and the building looks good. The drone flies over. The building inspector says XYZ is fine. You look at all these things, you don't think it's a problem. Did you get an expert building consultant to also look over that building report and say to you, what does that look like in practicality? Again, most buyer's agents don't have that. They go, here's a building report, we might negotiate an XYZ, that's it. That's a residential play. In the commercial space, you look at what's deal breakers. Is there a flash sheet? Is there a leak? Is it downpipes? Is it air conditioning? Is it like pavements? Anything that is CapEx that is going to cost you more than the cost of buying the property and wiping out your cash flow for the next 2 years, that is going to likely happen in the first 3 months. And so many people make this mistake. The building inspector didn't pick it up. Well, your buyer's agency team should have. Here at Unicorn, we actually have an in-house building consultant who looks at all the building reports and actually goes on site. If you're buying a more than $2 million property, you make sure that does not happen to you because we know to change air conditioning is about $3,000 to $5,000 each. And if you get 3 of those happening in the first 12 months, you've wiped out your cash flow. If you have to change roof sheets, $10,000, $20,000, wipes out your cash flow. Capital works has been a big, big killer in commercial property because people miss it all the time. Part of the thorough due diligence is to not only just look at the numbers, but to actually be on site. If your buyer's agent can't be on site, they shouldn't be a commercial buyer's agent. It's just all about the numbers. The numbers doesn't tell you is if there is going to be a major works that is going to impact your cash flow and impact your growth of that property, right? Going to take your tenant out. Capital works is really important. You're going to know what the tenant's responsible for, what you are responsible for, and also in the future, if they do move out, what are they making good of this property? What are they bringing back to natural state so that you can re-tenant it? So we always create a game plan for our clients. What we do is we say, here's your building report. This is what it's going to cost you in practicality. If it's things to fix, you probably need a handyman into the premise for about a week, which will cost you about $1,000 or $1,500 to fix all the little things to make your tenant happy. That's not something that's a deal breaker. However, if your building report saying some rusting roof sheets, some downpipe issues, and there might be some waterproofing issues, this could be $50,000 or $100,000. You need to absolutely go back and negotiate on it, or have money in trust, especially if you're buying strata and you've got capital works coming up. You need to make sure that's in trust from the previous vendor, so that you can actually use that money when you ask for that contribution. It's very, very important. Otherwise, you're going to be out of pocket of tens of thousands of dollars. The number 4 mistake most people get into is they buy specialist assets. Now, specialist assets look so good on paper. 10, 20, 50-year leases to McDonald's, KFC, petrol stations, your childcare, your hotels. Wonderful. However, they're specialized assets. What does that mean? It means the asset is so specialized for that particular tenant that it is very hard to repurpose it to another tenancy. Now, with that, typically you get a very low loan ratio, which is about 50%, which means you have to put in 50% deposit rather than 20 or 30%, which is standard in commercial. Now, 50% deposit is huge when you are thinking of starting. If you're buying a $2 million property, instead of putting in $400,000 or $600,000, you now need to put in $1 million. But also the banks sometimes don't actually like it because it's so specialized. So specialized means that they know that while you have that nice, consistent income coming in, if something does happen, if there's an act of God, if a black swan event, then that property could be vacant for 2, 3, 4 years, which is why they don't like it, and they give you 50% LVR, sometimes even hiking up the interest rates. So this is something that I would, if you're a first-time investor, totally avoid. If you buy into a syndication, then absolutely you can do it with a syndication because they get better deals and they can repurpose that asset much easily. Buy something that's more versatile, that you can replace the tenant easily and you can renovate and increase the value easily, where you can't for a childcare. It really sits there and just churn out 3 or 5%. But also, the returns on these specialized assets are really, really low. They're between 3 to 5% yield, which is like net yield, but it means that you're literally holding it for the bank. So why do it? So I would avoid it altogether. We come to the final one, which is about vacancies. Everyone avoids going in vacancies because they're worried about that in commercial property. You're worried about whether vacancy is going to wipe you out. Now, let me tell you that vacancies will not wipe you out. And if you do the calculation, having a commercial property that is vacant is actually almost equivalent to having a tenanted residential property in a regional area. And buy $1 or $2 million property, you'll find that you're probably negative somewhere around $30,000. If you have a vacant commercial property that's $1 million or $2 million, it's probably going to cost you $30,000 a year to be vacant as well. So the two is equal. However, a commercial property in metro should not be vacant for 12 months. It's probably somewhere going to be between 3 to 6 months. So what do you do? Firstly, during the time you own it, it's not going to be vacant tomorrow. When you buy it, to start out with, buy a tenanted commercial property. Do not buy a vacant commercial property hoping you could get a tenant and create that uplift as your first property. What you want to do is buy a tenanted commercial property on a 3 to 5 year lease to start with some options. What you do during that time is then you start building up a buffer about 3 to 6 months using the cash flow. Once that tenant tells you he wants to leave, you need to be proactive. You don't wait for that lease to expire to start advertising. You advertise 3 to 6 months beforehand because a tenant would have already let you know. In commercial, most tenants let you know 3 to 5 months, if sometimes even 12 or 9 months beforehand that they're about to leave. So then you start advertising and start marketing. And do not scrimp on your marketing. Pay for really good marketing. Get some really good agents who have proven track record. Make sure your property is clean, neat, and tidy and versatile. Bring it back to a bare shell that people can actually relate to, and they can move in straight away. So that's what you actually want to do. So that's number one way of avoiding vacancies. Number 2 is you've got to look at the demand and supply. Does your property have demand and supply? If everything in that building is gone vacant at the moment because it's just happened to be an office space, you're in transition, it is the market. There's nothing you can do about it. The one thing you can do is there is always an equilibrium what people will pay for versus what you want. Just happen to be in this part of the market where the cycle that you're getting a vacancy because your current tenant is moving out and it's a tricky time for office space. Now, you probably have lots of vacancies and you can't avoid that and you don't know what to do. However, your rent might be currently $30,000 or $40,000. Instead of that, charge $20,000 or $25,000. You undercut the market, you bring someone in who needs cheap rent. Now, you might be thinking, oh, I'm making a loss, but no. What you're doing is you're holding out through the market, right? You're making a greater loss by trying to sell the property than to just offer it for $20,000 or $25,000, where you just get a tenant in 12, 18 months or 2-year leases where they cover the basis of your outgoings and also the basis of some of your mortgage. You'd rather be negative 10 grand or 5 grand rather than 30 grand. So this way you go, yep, the tenant's taking care of that. In 2 years' time, as the market heals and gets You kick out the tenant, or you can do a rent review because the tenant is actually happy there. You know what? The market is 40,000 now if you want to stay. Otherwise, you can move it on and bring new tenants in. That is the smartest play in the commercial space. It's having a loss, but having a much mitigated loss than you would if you just left it open, hoping to get the same tenancy with the same type of rent, right? Because it is a market issue, not a property issue. If it's a property issue, there's stuff you can do. Tidy it up, refurbish it, put a new fit out in there. When you go and pick your commercial property and you're engaging in a buyer's agent, the buyer's agent need to know what's happening in the moment, what's happening in the market, what's the correct returns, and that they're able to have the skill set to be able to read a lease, understand the outgoings, and be able to produce a preliminary spreadsheet. If they cannot do that, they're not in the commercial space. When you go and pick a property, make sure you look at these 3 big things. Firstly, is the location in demand? It doesn't have to be in demand today, but is there a trend that there's more people moving to the area, more demographics, more shops, and is the leasing rates going up? Number 2, is this property versatile enough for me to go from one type of tenant to another type of tenant to another tenant if I have to? And number 3 is that am I buying it at the right returns with the right yields in this current market with the right lease? So many people miss this, right? This is a big, big no-no. They miss this because they bought it at much higher price point, lower returns than they anticipate. Now they have to hold regardless. Am I buying at the correct returns? Because if you're not buying at the correct returns, this is where you can go into negative equity territory. So make sure you get those 3 things and you work with a team that surrounds you, help you with finance, due diligence. Strategy is most important. Don't just go out there and buy anything. But if you can implement those 3 things plus a team, you're on a winner. Like, subscribe, follow me on Insta. More tips, tricks on commercial property investing. If this video has been helpful, put a comment below about DD and I'll send you my DD spreadsheet. Share it around and let's get started in building your financial wealth through commercial property.